Hey folks, Dan Lohmar, CFP professional with United Wealth Management. You know, we have this election coming up in about a month and a half or so between, it's going to be Kamala Harris and Donald Trump, the 2024 presidential election. And every 4 years when we have this election, this uncertainty comes up as to how the economy is going to be impacted, how the stock market is going to be impacted. And so it raises questions, should we be changing our investments based on what we think is going to happen or even after the election? And we know what happens, who's going to be in the White House or in the Congress or the Senate. Should we be changing our investment policy? So this comes up every 4 years, and it doesn't really matter which side of the aisle you sit on, which candidate you're supporting, which party you're associated with, or whether it doesn't matter. I hear the argument, I hear the concern on both sides. Of course, if your candidate or your party gets elected, everything's going to be perfectly fine. But of course, if the other guy gets in, then there's always concern about it. And just keep in mind, if you have those concerns, I hear them on both sides. And so neither person is neither wrong nor they're right. And so what we have to do is we have to go back and look at the evidence as to say, hey, look, what does history suggest as to what the economy and the stock market's going to do, or how it's influenced by who's in the White House or who controls the House or the Senate. And so 4 years ago, I did a video on this very same topic, kind of addressing those things, and that was coming up on the election between Biden and Trump back then in November of 2020. So I kind of highlighted these things. I kind of looked at the history. And if anything since then, nothing's really changed. If anything, the evidence, the historical evidence that we looked at back then, it has not changed. It's only gotten stronger to kind of make the points I made back then. So just to kind of review that, what that stuff was, and then there was certainly concerns on both sides. Again, that nothing was new back then. I had people call me and say, hey, if Biden gets in, I'm going to bail out, or I want to get out, I want to liquidate, I don't trust this, so on. And I heard the same thing. I heard the same thing if Trump got into the White House. So again, the argument goes both ways. But let's just kind of look back of the past 4 years and kind of see what has happened. And I think what you'll see is the things that really drove the economy since that time, the most impactful events, were not necessarily directly related to what was going on in the White House. I'm not saying that there was no influence. That's not what I would suggest at all. But it's not to say that we could identify some of these things in advance, and that there was clear evidence as to how this kind of played out over the past 4 years. But anyway, since Biden became the president in January 2021. From 2019 to 2021, the House and the Senate were divided. From 21 to 23, Democrats controlled both the House, the Senate, and the White House. And from 2023 to today, the House and Senate are divided, and Biden, a Democrat, is in the White House. In addition to that, some of the more impactful events that really, some historical events that we saw both within our country and worldwide that we don't typically see in any 4 year period. We saw January 6th riots on the Capitol. We saw mass riots in cities throughout the country. 2 global wars started and continue to this day. 2 assassination attempts on Trump. Massive inflation in 2022 with historical rise in interest rates. And Biden stepped aside as the Democratic nominee and just a few months ago. And despite of all this and a healthy stock market correction in 2022, the stock market has plugged on to new highs. The main point being that beside the political turmoil and uncertainty, corporate earnings and the economy have continued to do what they do over time, and that is grow and be profitable. And this is nothing new. History suggests that no matter what the political backdrop is of any particular period, our great American and international corporations that we invest in continue to be innovative. They continue to adjust to new laws and find ways to be profitable and efficient. And people worldwide continue to want tomorrow to be better than today, meaning we continue to invest in our future. With this in mind, you might say that politicians get way too much blame and way too much credit for what happens in the economy and the stock market. Because the evidence has not really changed in the past 4 years, and things have only gotten stronger, if anything, as far as what that evidence suggests. And those are the points I made back in the video in October of 2020. Instead of me rehashing that information and redoing that video, I'm just using this as an opportunity to reintroduce the same video and kind of point out the same lessons. The same core lessons have not changed. One, politics and money are emotional. Try not to let one cross over into affecting the other one in your life. Two, nothing in history suggests that we should change our investments because of what we think is going to happen within the political environment. And three, even if there was correlation between politics and the stock market, there's nothing that suggests we can identify the most impactful events ahead of time. With that being said, thanks for tuning in. Here I am in October of 2020 talking about your money and politics. So let's jump right into it. Politics and money. What is the real challenge here? Politics and money, both of them go right to the core of who we are as individual investors and as people. Because of that, they're both emotional topics. And the mistake we can make as investors is getting the two of them mixed up. So that's the challenge here. That's what we don't want to do. Let's look at the evidence. And if you should be talking to your advisor about the evidence, and that's one of the best things you can do and have an advisor for is that that third party out there to just kind of give some unbiased information and just kind of keep things unemotional. As Warren Buffett said, the best, if you can't control your emotions, you can't control your money. And that's really what we're talking about today. So politics and money, let's get into it. Let's just look at election years. Did election years, being the fact that it was an election year, did the election year itself have an impact on market returns? And going back to 1928, we've had 23 elections. And of those, 19 positive, 4 negative, average return 11.3%. Nothing in those numbers is different than any other year. So the election years by themselves don't have a big impact on the full year return of that year. Now let's look at history. Are there things we can learn from those years in which we had negative returns? There absolutely is. 1932 was the worst year of the Great Depression. In 1940, it became very obvious World War II was going to be a bigger thing than what we anticipated originally. In 2000 was the beginning of the dot-com bust. Now, there was some uncertainty around the election. At election time, it took a couple weeks to determine who the president was going to be. But in and itself, that did not affect the entire year's return, maybe a little bit during that time period. And then in 2008, we had a negative return during that election year, but that was right in the midst of the financial crisis. So not a lot of evidence that the election year by itself sways investment returns one way or the other. One thing I'll say, though, with the election coming up, is it's normal to have some volatility in the weeks and days leading up to the election, especially in a closely contested election like it is. Back in 2016, we saw volatility build up, big swings in the market build up leading up to those days. On the day of the election, the market tanked. And then the next day, it snapped right back and resumed its normal trend. So, keep that in mind as we get closer, is that some volatility around the election, especially as close as it may be, is pretty normal. How about the years after the elections? Let's take a look at those things. Can we make any policy or see any strong evidence that we should do anything different in years after the election? It is a little bit different. Again, 23 election years. We had 10 negative years, falling years after elections, and then 13 positive, of course. But the average return in the year following election, 9.9%. Okay, so there's nothing really overwhelming that is going to make us say, because it's the year after the election, or because a president or a party is in control, which we'll take a look at that in just a minute, that's going to sway us one way or the other, that we're going to change the way we invest based on those things by themselves. Let's take a look at the terms of the presidents by themselves. Did the party or the president in office over their entire term have an impact on the investment returns themselves and again, to the point where we could say ahead of time that we're going to change policy based on a president or a policy in office. We've had 15 presidents going back to 1929. 8 Republicans, 7 Democrats. Is about as split down the middle as you can be. The average return during presidential returns was 10.3%. Of those 15 presidents, we had 3 of them that were negative. Let's take a look at that. What lessons can we learn? Hoover came into office at the end of a bull market and left during the Great Depression. Okay, so that explains a lot for the negative return there. Nixon came into office as the gold standard was transitioning, and also the oil embargo had a big impact on stock market returns during that time period. And then Bush came into office right as the dot-com bust was starting, and then left office as the financial crisis was towards the bottom. So clearly that was a negative return during his tenure. We can always argue, we can always ask, did the president themselves during that time period have an impact on those returns? Would they have been better or worse based on the policy that the president used at the time? And you can always argue that. Hindsight's always 20/20. The question, though, is ahead of time. Can we tell ahead of time that a president is going to have a positive or negative impact on the events that happen at that time, the world events, the economic events, and how are they going to do that? So it's not clear at all ahead of time that we want to change investment policy based on who the president's going to be or what policies they might have. And the big thing here is that, in this case, politics is a variable in driving returns, but it's not the variable. There's always big market or world events that are usually the bigger returns of what the market do over a period like that. So as you can see here, no matter who's in office, red, blue, Democrat, Republican, who it is, the market has rewarded long-term investors under a variety of U.S. presidents. Let's take a look at the party in control of Congress. Did the party in control have an impact? Clearly, one party over the other. Again, we'll look at history here. So, in both of them have had long periods where that party was in complete control of Congress. So, back in the 50s, 60s, through the 70s, the Democrats were in control. And yeah, good economic growth, good investment returns during that period. During the 90s, late 90s, 2000s, Republicans were in control. Again, good economy, good stock market returns. So there's no real clear evidence that one of them did better than the other. You might ask, well, was the volatility any different? Was the ride any smoother? Both of them had periods in which we had just negative stock market returns. So there's no clear distinction there. And then what about this? What about when both of them are mixed? Again, really not much different. Mixed parties, good. Again, good investment returns, historical average investment returns, and economies along with that. So really, again, no clear evidence as to if one party or the other is in office, which way it's going to be. So what about social programs and tax policies? That's always a hot button item. And the theory being that higher taxes and social programs would be a hindrance to stock market returns in the economy. And the other side of that would be lower taxes and smaller government would be a benefit to the economy and stock market returns. But again, the evidence isn't really clear, and I'm not getting into a lot of deep theory about the costs and benefits of social programs and tax theory. That's not what this is about. Let's just take a quick look at a couple cases of very anecdotal evidence in history as to say whether those theories are completely supported in the fact that those policies are not necessarily the primary drivers of the investment returns we're seeing here. So what we saw in two presidents, very tax-friendly presidents, President Reagan cut income taxes quite a bit over his term, and as we see over his term, he had positive stock market returns over his presidency. And then George Bush, again, he cut taxes twice, but over his entire term, stock market return was negative during his term. And again, the biggest thing here is that, again, tax policy is a variable in stock market returns, but it's not the variable. Both of them had world and economic events that are going on in addition to the tax policies that they implemented that either added to or took away from the policies themselves. So again, not enough evidence here to say that one, it would be implemented, and two, what the impact would be, because there's a lot of things to take into account. So let's just take a look at two cases of big social programs that were put into place. And the first one is back in 1935, Social Security, as we know. And again, it's not like the economy or the stock market halted because the Social Security was put into place. Long-term investors have been rewarded for investing in the stock market, even with Social Security in place. And it's hard to argue. You could argue one way or the other, whether it was a benefit or a hindrance to what the returns would have been. It's not clear. And then same thing with Obamacare in 2010, not quite as much evidence there. It's a slice of history. But again, there's no evidence at all that it really slowed the stock market down during his period. So that's it. Just to kind of summarize things, hey, money and politics, both of them are emotional. We don't really want to get them mixed up. Make evidence-based, rational decisions. Talk to your advisor. That's what a good advisor is there for. Politics is a variable when it comes to stock market returns, but it is not the primary driver. There's a lot of economic things going on, and tax policy is just one of them, or politics in general. We can always argue in hindsight as to what a policy did to impact returns, but there's not enough evidence to change policy ahead of time as to how that might be. And then the other thing too is always keeping in mind that if you're thinking about something in the stock market, so are many other investors, to the point where the market's going to price those expectations and those concerns into their stock market returns accordingly. So it's a very efficient market, and it's really hard to anticipate things ahead of time and jump on it. So there you have it. You've seen some historical evidence, and you can use that information to decide whether you should change your investment approach or your investment allocation. And again, everything I talked about was based on a globally diversified portfolio of high-quality investments. I'm Dan Lohmar with United Wealth Management. If you're a United pilot and you could use some assistance in financial planning or developing an investment strategy, please reach out to me at dan@unitedwealthmanagement.com. Until next time, fly safe.